Look closely at your local coin shop. Something historic is happening. Across America, the lines are wrapping around the block, but people aren't rushing in to look closely at your local coin shop. Something historic is happening. Across America, the lines are wrapping around the block, but people aren't rushing in to buy. They are desperate to sell. Local dealers report a staggering 10-to-1 ratio of sellers over buyers. On the screen, the paper price of silver on the COMEX is being hammered down toward $80. Panic is everywhere. But behind the headlines, a terrifying disconnect is brewing. The Silver Institute just confirmed that the physical market is plunging into the most severe structural supply deficit in history. The culprit? Silicon Valley's insatiable hunger for the AI revolution. It is a madness. The price is crashing while the physical supply is completely vanishing. Why is the one asset the tech elite need to power tomorrow's AI grid being sold for pennies on American street corners? This isn't a free market, it's a trap. To understand how we got here, we have to look at the scoreboard. Just weeks ago, silver was riding a massive wave, touching $90 an ounce. The momentum felt unstoppable. Stackers were celebrating. But then, the floor dropped. In a matter of days, the spot price was aggressively driven down, slammed straight into the $80 support zone. On the surface, it looks like a brutal rejection. It looks like the rally is dead. But that's not the real story. What you are looking at on your screen isn't real silver, it is paper. And behind the scenes, the game is heavily rigged. Right now, giant institutional hedge funds are playing a highly calculated game on the COMEX. They are deploying massive short positions using a predatory tool known as iceberg orders. Think about an iceberg. You only see the tiny tip above the water. Below the surface sits a massive, crushing island of ice. That is exactly how these sell orders work. The algorithms show the public market a small, harmless sell order. But the moment it gets filled, another one instantly takes its place, and another one, and another one. It is a relentless, artificial supply waterfall. The goal? To create the illusion of total market exhaustion, to make retail investors believe that everyone is dumping silver, causing a massive psychological panic. And this is where things get dangerous. As the paper price artificially drops, it trips the wire. It forces automated trading programs to hit the panic button. Algorithmic selling kicks in. Stop losses are triggered across the board. The market begins to feed on its own fear, sending the price into a controlled freefall. But why now? Why target silver at this exact moment? Because the big players know something you don't. They are weaponizing the economic pain of the middle class. Let's look at the hard macro data. If you check the official FRED database from the Federal Reserve, the reality is devastating. U.S. household credit card debt has just smashed through its highest historic peak. Delinquency rates are spiking. The average American consumer is completely maxed out. They are drowning in inflation. They cannot afford groceries, they cannot afford car repairs, and they cannot afford gas. They are backed into a corner. And when you're trapped, you do the only thing you can. You liquidate your safety net. Wall Street knows that retail stackers are hurting. They know that thousands of families are being forced to take their physical silver down to the local coin shop just to pay the electric bill. This is an engineered liquidity squeeze. The hedge funds are deliberately depressing the paper price to create a climate of total hopelessness. They want you to look at the falling price, look at your bills, lose faith, and dump your physical metal. They are hunting your stops. They are draining your local shops. They are manufacturing a paper panic, specifically designed to shake the silver out of your hands so they can buy it from you at a major discount. But here's the ultimate twist. While the paper market screams crash, the physical reality tells a completely different story. Lifting the curtain on Wall Street reveals an undeniable truth.
According to official reports from Reuters and the Silver Institute, the global silver market is entering its fifth consecutive year of a severe structural supply deficit. Physical silver is disappearing from global vaults at an unprecedented pace. It is a mathematical drain. Because behind the headlines, the modern world is facing a brutal reality. Industry cannot run on paper contracts. You cannot build a solar panel out of a COMEX futures receipt. You cannot power a supercomputer with an algorithmic short position. Technology demands physical atoms, and right now, the tech sector's thirst for silver is exploding. Look at the hard data. Every single solar cell manufactured today requires immense amounts of silver paste to conduct electricity efficiently. The green energy transition is literally swallowing the silver supply whole. But it gets even tighter. We are currently living through the most aggressive infrastructure buildup in human history, the AI revolution. Every new data center requires thousands of high-performance electrical switches. Every advanced AI chip requires silver-coated copper components to handle the massive heat and power load. Every automated electric vehicle rolling off the assembly line uses double the amount of silver found in a traditional combustion engine. The industrial demand is non-negotiable. Technology companies cannot just substitute silver for a cheaper metal without sacrificing massive performance. So ask yourself, if demand is skyrocketing to historic highs and physical supply is plunging to historic lows, why is the price falling? This is where the counterpoint becomes clear. When you zoom out and look at the long-term technical chart, the answer stares right back at you. Silver's price action is currently hammering against its crucial 200-day moving average. In public trading, retail investors look at the drop toward $80 and see disaster. They see a trend breaking. But the smart money looks at $80 and sees a generational gift. This isn't a market top. This is a classic accumulation zone. While the average retail stacker is panicking, shaking out, and selling their silver back to local coin shops to cover credit card bills, institutional buyers are quietly doing the exact opposite. They are using the depressed paper price as a smokescreen to vacuum up every single physical ounce they can get their hands on. They are absorbing the panic. They are feeding on retail fear. Every ounce sold by a stressed consumer to pay a bill is immediately bought up, melted down, and shipped directly to industrial processing plants or massive private institutional vaults. The physical metal is moving from weak hands to strong hands. It is shifting from those who are forced to look at today's price to those who are looking at tomorrow's scarcity. And this creates a massive structural spring. The more the paper price is suppressed while physical metal vanishes, the tighter that spring gets round. The paper panic is temporary, the physical shortage is permanent. And when the music finally stops, the rush to find physical metal will trigger a squeeze unlike anything the financial world has ever seen. This deep disconnect between paper prices and physical reality isn't just a market anomaly. It is a canary in the coal mine. Because behind the headlines, this divergence is the classic warning sign of something much darker: the slow, undeniable decay of the fiat currency system. For decades, the global financial structure has relied on a single premise, that a piece of paper backed by a government promise is as good as gold or silver. But history is unforgiving. Every single fiat currency ever created has eventually returned to its intrinsic value, zero. Right now, institutional giants are quietly preparing for that exact endgame. They can see the staggering multi-trillion-dollar sovereign debt mountains growing out of control. They can see the purchasing power of the US dollar and the euro being systematically eroded by persistent inflation. They know the system is fundamentally broken.
And as confidence in the paper dollar continues to fracture, the underground war for hard assets is about to break out into the open. But why isn't the general public screaming for silver? Why aren't average investors rushing to protect themselves? Because they have been conditioned into a state of total psychological paralysis. In behavioral finance, this is a dangerous phenomenon known as risk numbness. Day after day, the mainstream media bombards the public with a non-stop, exhausting cycle of negative news. Geopolitical conflicts, sinking stock indices, economic warnings, real estate collapses. When your mind is constantly flooded with crisis after crisis, something shifts inside your brain. The amygdala, the ancient, primitive part of the human brain responsible for the fight or flight response, reaches its absolute limit. It burns out. You suffer from intense decision fatigue. You stop reacting to danger because danger has become your baseline. You become numb. And this is exactly what the elite financial institutions exploit. When the paper price of silver drops, a numb retail investor doesn't see a manipulated market or a strategic buying opportunity. Their exhausted brain interprets it through pure survival instinct. They see red on the screen. They see a collapsing asset. Their primary urge is simply to make the pain stop, to find safety. So they capitulate. They flee. They liquidate their positions at the absolute worst possible moment. By dumping their physical assets at the very bottom of the cycle, they are unwittingly handing over the most valuable non-custodial insurance policy on Earth directly to the world's largest banks. It is a psychological masterclass in wealth transfer. The public is terrified into giving up the ultimate protection asset right before the system needs it most. But this desperate game of paper suppression has an expiration date. You cannot print physical atoms out of thin air. And this brings us to the ultimate future scenario, the inevitable emergence of a dual pricing system. Right now, the financial elite are desperately using millions of paper contracts to suppress the spot price. But the physical stock on the COMEX in London vaults is steadily bleeding dry. What happens when an industrial giant, an aerospace contractor, an AI chip manufacturer, a massive solar developer goes to the exchange to demand physical delivery of their silver and the vault doors open to reveal nothing but empty shelves? That is called a default on delivery. When that inevitable day arrives, the paper market will instantly break. The millions of synthetic paper contracts traded digitally will become completely worthless overnight. They will be exposed for what they truly are, pieces of paper backed by nothing. At that exact moment, the market will split in two. The paper price on the computer screen might say $80, but if you want an actual physical ounce of silver to keep a factory running or to protect your family's generational wealth, you will have to pay whatever the physical owner demands. The physical price will completely detach from the paper spot price. It will skyrocket. The illusion of cheap, abundant silver will vanish in an instant. The hidden deficit will finally collide with reality. And those who allowed themselves to become risk-numb, those who looked at the manipulated digital screens and sold their physical metal for depreciating paper bills, will look back and realize they made the most catastrophic financial miscalculation of their lives. The writing is on the wall. The physical supply is draining. The paper manipulation is fracturing. The structural trap is set, and the jaw is about to snap shut. When you step back from the daily noise, the bigger picture becomes crystal clear. We are not just witnessing a temporary dip on a trading chart. We are watching a historic, quiet transfer of wealth, a massive migration of hard assets away from those who are financially exhausted straight into the hands of the strategically patient. The games being played on digital screens cannot last forever. When the dust from this paper sell-off finally settles, reality will strike. The tech conglomerates and AI data centers will look to secure the physical silver they desperately need to run tomorrow's empire, and they will find the vaults completely empty. At that exact moment, the price printed on your computer screen will become totally meaningless. When that final scenario plays out, which side of history will you be on? Will you be left holding depreciating paper promises, or will you be holding the actual physical asset the world is starving for? Check your portfolio. Assess your risk. What are you seeing at your local coin shops right now? Let me know in the comments below. Subscribe to the channel and stay ahead of the macro shift.